Hey everyone, welcome to Accounting Fastly. In today's video, I want to share with you how to identify and record business transactions. Category 1, Assets. As you may have heard before, money flows like water. Actually, transaction happens in your business always have equivalent effect to someone else. Many people find it very challenging to really understand how debits and credits works. And after years of diving, I have these tricks to share with you. I'm sure after today's video, you will never forget how accounting debits and credits works. That's how powerful. Please make sure you stick to the video. Accounting is business language, so for accounting to provide very good business insights to decision makers, we have to collect all the business transactions and record them according to the gaap, which general accept accounting principles. So by recording them in the right accounts at the end of the month or at the end of the year, you can really tell how the business situation is. Anything brings you inflow to your business. For instance, brings you more cash, brings you more stocks, brings you more equipment, or bring anything to eventually create your business better. Those are the accounts considered as debit accounts. For instance, cash, accounts receivable. Let me explain. Accounts receivable is the account when you selling the service or product, people do not pay you cash right there and they pay you on terms. For instance, in 10 days or 15 days. So this is the account eventually gonna bring you the inflow like a cash. So this is the debit account. For instance, equipment. You buy equipment to generate more products for selling, to making the product. These are considered as debit account as well. What are the credit accounts? Credit accounts like accounts payable. Accounts payable are the accounts you normally buy products from a manufacturer. You didn't pay them upon the receipts and you paid in 30 days or 15 days, depends on the agreement. Eventually will brings your cash lower. Another example, bank loans. And the more bank loans you borrow, the more money you will have to pay back along with the interest. So this bank loan account is also a credit account because eventually will make the outflow effects to your business fund. Based on accounting principles, every business happens, you have to record it. Because think about it, you pay the cash to buy some equipment. There are two accounts always being affected. Or you paying the wages to your employees and your expense account, you pay from the bank, your cash is lower and your expense will go up because you paid your employees' salaries. So based on the accounting principles, every transaction happens will affect two accounts. That's why we record each business transactions in two accounts. We normally display them as T accounts. Like I just mentioned, if the account by nature is a debit account, like any accounts bring you the money to the business. So if this account have increase, then you need to record them on the left side of this T account to show the increase. If this account have a decrease, you would record them on the credit side to show the decrease. For instance, if you buy equipment with cash, your equipment account will go up. Since equipment account is a debit account, the go up side will be on the left. And the cash account is also a debit account. The decrease side will be on the credit side, on the right of this T account. Second example, accounts receivable. Increase the accounts receivable because accounts receivable will eventually bring you the cash to the business. So it increase on the left side of this T account. And what is on the right side? Because you made a sale, so you will record your revenue account. You must have a question, why revenue account would be recorded on the right side? Revenue account is something you have to put more money in to make money. That's why revenue account by nature is creating the outflow for your business. That's why we consider revenue account as a credit account. So when revenue account increase, it's going on the T account right side. You're selling on cash. You receive cash. Your cash will increase and your revenue will increase on the right side as well. Let's recap. We talk about debit account and credit account. The tip to take away is to remember debit account is always something brings you inflow. It's like brings you cash, brings you equipment. All these accounts are debit accounts, which creates inflow to your business. And the credit account would be accounts creates outflow for your business, like bank loans, accounts payable, and long-term bonds are those accounts are creating future outflow for your business. So they are credit accounts. I hope you found today's video helpful and hopefully you learn accounting tips. If you haven't subscribed my channel, please feel free to subscribe. And if you find this video helpful, please share with your friend as well. Next video, we're going to identify and record the second category, liabilities transactions. Until I see you in next video, please take care.